Welcome to Speidel's California Minute. I'm your host, Catherine Zidane, and this week we're talking about a way you can help clients avoid tax when they retire outside of California by structuring payouts to take advantage of a carve-out from California taxation. Planning tips like this are covered in Speidel's California Tax Letter. For more information on this monthly publication, visit caltax.com and click Publications. Most tax professionals are familiar with the federal and California laws that prohibit California from taxing a non-resident's income from pension and retirement plans, even if the amounts in the plan accounts were contributed while the person was a California resident. But many tax professionals are not aware that this prohibition also applies to certain payments from non-qualified deferred compensation plans, or for retiring partners, any written plan, program, or arrangement that provides for retirement payments in recognition of prior service. To qualify, the payments are required to be made for either the life or life expectancy of the recipient, or the joint lives or joint life expectancies of the recipient and the designated beneficiary of the recipient, or a period of not less than 10 years. So even though we typically think of deferred payments for services that were performed in California as being taxable to California, they may not be. We're seeing more and more of our clients opting to leave California when they retire. As practitioners, it's important to understand when these payments can avoid California tax. This will help you to help your clients during the planning process and to make sure that the entities making these payments are reporting them correctly. If one of your clients is considering moving outside California for retirement, you should discuss how their payments from non-qualified plans and/or from a partnership they may be leaving should be paid out to take advantage of this carve-out from California taxation. If these taxpayers have options to negotiate the terms of those payments, they may want to consider the ability to avoid California tax in the future. As an example of structuring payouts, assume that Rudy has worked for a consulting firm in Los Angeles for 25 years. As part of his retirement package, he'll receive $1 million in non-qualified deferred compensation. Rudy has the option of receiving those payments over a 5-year term or a 10-year term. Rudy is going to retire to Las Vegas. If he chooses the 10-year term, all payments he receives after he moves to Las Vegas will not be subject to California tax. And because Nevada has no personal income tax, this means the income would be tax-free for state purposes. If, however, he opts to take the 5-year term, all of the payments would be subject to California tax. Keep in mind that California looks to a non-resident's worldwide income for purposes of determining the tax rate applied. As a result, if Rudy's total annual income is more than $406,000, he would pay California tax of 11.3% on those deferred compensation payments, increase to 12.3% tax if his annual income is over $677,000. You can pre-order the 2024 edition of Speidel's Analysis and Explanation of California Taxes, which is the most complete and best-priced California tax guide that also includes periodic updates for major changes that happen during the year. Get more information and download a sample table of contents at caltax.com under Publications. That's all for this week. Join us next time for another episode of Speidel's California Minute.